So asset allocation across portfolios. Asset allocation is simply portfolio choice among broad investment classes. Complete portfolio represents the entire portfolio, including risky and risk-free assets. In the first example we're going to look at, we're going to have a risky portfolio and the risk-free asset, and the choice that you make is you're going to choose between the two. So you're going to allocate all of your assets between the two. So capital allocation is simply that choice, the choice between the risky and risk-free assets. So the risk-free asset, typically we use treasury bills actually. Treasury bills and bonds still affected by inflation. They are effectively risk-free because if the U.S. government has trouble paying paying their debt, we've got a lot bigger problems to worry about. There's price index government bonds. Those are TIPS or Treasury inflation protected securities. Those are certainly very close to risk-free as well. Other examples, money market instruments are very close to risk-free as well. CDs and commercial paper, risk is pretty minuscule as well. So our portfolio is going to calculations are we're going to use these formulas. The expected return of the complete portfolio is simply, and that's ERC. That is equal to Y, which is the weight in a percentage or the percentage of assets in the risky portfolio, multiplied by the expected return on the risky portfolio, plus 1 minus Y. So you're basically saying whatever you didn't put in the risky portfolio, you're putting into the risk-free asset. In the example that I did in in the recording, I use W and Y are interchangeable depending on the book you use, the type of problem you're working. You'll see both. So again, R sub C, expected return on complete portfolio. R sub P is expected return on risky portfolio. RF, risk-free asset. Y is the percentage of assets in the risky portfolio. And then the standard deviation of the complete portfolio is simply the weight or the percentage of assets in the risky portfolio multiplied by that standard deviation. So since the risk on there is the standard deviation on the risk-free asset is 0, you don't have to consider that. So, but we can easily calculate if we have the standard deviation for the risky portfolio, we can easily calculate the standard deviation for the complete portfolio. The figure 5.6 represents a investment opportunity set. In this, we'll always have the expected return on the y-axis, standard deviation on the x-axis. What we're doing here is we're deriving the capital allocation line for this specific portfolio and risk-free asset. This portfolio, the risky portfolio, has an expected return of 15%. We've got a risk-free rate of 7%. Our risky portfolio has a standard deviation of 22%. So if we look at what here 50%, 50-50, we're splitting evenly. We would be it would be a split 50% in risk-free asset, 50% in the risky portfolio. Our expected return would be 0.5 times both of those. That would I believe that would be roughly 11%. So we could also calculate our standard deviation. That would be 0.5 times 22 or 11%. So out here, y equal 1.25. What we're doing, what this represents, borrowing money to invest, investing on a margin. Think of it that way. So um, the excess return here, 8%. So, capital allocation line. We saw that on the previous graph here. The capital allocation line plot is the plot of all risk return combination available by varying the allocation between risky and risk-free asset. The risk aversion and capital allocation. Y equals the preferred capital allocation. Available risk premium to variance ratio. So that's simply the expected return on the portfolio minus the risk-free rate divided by the variance of portfolio multiplied by A, which is the coefficient of risk aversion. So we can rearrange that over here. Expected return on the portfolio minus the risk-free rate divided by the coefficient of risk aversion multiplied by the variance of the portfolio. Passive investment strategy. The passive investment strategies have been really popular and really successful, especially since the financial crisis. Every year since the financial crisis, passive investment strategy has outperformed managed strategy. And for the most part, over time, passive strategy has outperformed active management strategy. But passive strategy is investment policy that avoids security analysis. Simply, you're going to invest. You're going to choose you're going to invest in the market portfolio. So, capital market line is a capital allocation using the market index portfolio as a risky asset. The investor's choice is just what portion of their assets to put into that risky portfolio. Cost and benefits of passive investing. Passive investing is inexpensive and simple. A good way to participate in passive investing is with exchange traded funds. You can invest in exchange traded funds with annual expense ratios of less than 0.25%, certainly. Some less than a tenth of a percent annually. So the cost of investing, where a managed portfolio can cost 2% or more, and there's truthfully very little proof that managed portfolios outperform passive portfolios, and for the most part, passive investing beats active. So the expense ratio of active mutual fund is around 1%. What I was referring to 2% is you hire a professional to manage your portfolio, that can run into +%. Expense ratio of hedge fund averages 1 to 2% plus 10% of the returns above the risk-free rate, not to mention the minimum investments involved. So they can run into the millions of dollars, which most of us don't have. Active management does offer potential for higher returns, but it also offers a greater downside. The risk is much greater as well.